and mining are reacting to the market. But very few are actually modeling how shocks move through the system. In this dashboard today, I'm going to show you how global natural gas markets are tightening and what that matters for pricing, risk, and strategic decision making. My name's Nick. I build market intelligence models focused on energy, commodities, and financial markets. This is part of a broader framework I'm developing to help companies understand how supply shocks impact inflation and ultimately flow through to financial markets. Let's start with the structure of the global gas market. So we've got global dry natural gas here. This is a global market analysis here, retrieved from both EIEA and investing.com for these data sets. Investing.com was used for crude oil prices and gold for this, and the rest was EIA. Okay, so what we can see here is that demand has grown consistently over time. So to look at that here, this is the oil consumption versus the annual consumption of gas here. We can see between the two, they both trended up over time. Gas has been quite strong there, exponentially going up. Production has largely kept pace. So, if we look here, we can see that, annual production of gas here in relation to the oil price, its production's gone up. And we can also see here that very tight here in terms of global balance of supply and demand of annual production of gas versus annual consumption of gas. Okay, so and then we can sort of look at the daily gas consumption here. So this is the annual figures sort of down here with a daily average for consumption, and then the global dry natural gas market balance. That's the difference between production and consumption again here. So we can see, what that market balance sort of has looked like over time. Okay. But importantly, the gap between supply and demand is narrowing. Okay. So the first one I'm going to get up is this, and we can see there that really tight here between supply and demand in 23 and 24, whereas we had some little gaps here, as you can see down here, 2012, 2013, there were some little gaps. And then down here, some little gaps again, okay? And even just in the, 2011, 2012, there were some gaps, there's sort of, bigger, larger, much sort of more significant gaps than what we sort of saw here in 23 and 24. So this tells us something critical. It tells us that the system is becoming tighter, and when energy systems tighten, they become much more sensitive to disruption. Now, if we look at supply versus demand more closely, you'll notice that the surplus buffer we used to have, particularly in the 80s and 90s, has reduced significantly. So we can see here in the 80s and the 90s, okay, we had a little bit of a surplus, but to see that better, we're going to need to go here to the market balance. Okay, so if we look here at the 80s and the 90s here, we sort of had a bit of a we had a bit of a surplus buffer there. So what this means in practical terms is there's less margin for error in the system. So any disruption, whether geopolitical, weather related, or infrastructure driven, this has a much larger impact on price. And this is where we sort of move into market balance and volatility. You can see that volatility has increased post 2000s. So over here, you can see a lot of up and down here. in a surplus, in a deficit, in a surplus, in a deficit, surplus, deficit. Okay. And this aligns with increased global demand, greater reliance on LNG trade, more interconnected energy markets, and this results in a system that is structurally more reactive. Okay. Now, if we look at this um, in terms of a macro perspective, when we compare gas to oil, okay, so that's coming over here, natural gas versus crude oil average. Okay, so this is dry natural gas because that's all I can sort of get the data on here. Um, so we see a strong correlation in consumption trends. Uh, so between gas and oil, sorry, we'll go to this one here. This is better for that. Okay, so oil consumption versus annual gas consumption. So we see a strong correlation in consumption trends here. This tells us these markets are driven by the same macroeconomic forces, but they can diverge when constraints appear. Okay, and we can see here that bang, there's a difference. Here, one dropped, one went up. Oil dropped and gas went up. Down here, pretty close together. Okay. Um, so when we look at these divergences, these can create opportunity and risk in both these markets. Um, so next one I want to get to is macro signals here next. So macro signals here, gas versus gold. Okay, so we can start to see signals around, sort of inflationary pressure. As energy demand rises, input costs increase, inflation pressure builds, and central banks react. This is where energy markets begin to influence the broader economy. Okay, but if we look here at gas and gold average price, so gold average price here versus the annual gas consumption of gas, we can see that um, you know, there is some, when we see a spike here, or we see gas drop there, the price of annual gas consumption drop, there's a little increase there in gold. So, um, that's interesting there. If we look at that in 2008, we saw gold increase here because everyone moved from commodities and other equities into gold in a form of crisis. And that's kind of what you sort of see here amongst these particular crises. Um, so if we step back, the key takeaway is this. Global gas markets are transitioning from a balanced system to a tighter, more fragile one. And that has three major implications: increased price volatility, greater exposure to geopolitical shocks, and stronger transmission into inflation and financial markets. So you might think, why does this matter? The companies operating in mining, energy, or the industrial based sectors, this isn't just academic, this impacts cost structures, pricing strategy, risk management, and capital allocation decisions. The companies that understand this early can position themselves ahead of the market. Okay. Um, and to close out, this is just one part of a broader market intelligence framework I'm building, covering oil, LNG, choke points, and global supply chains. If you work in energy, mining, or trading and want to understand how these dynamics affect your business or the work that you're doing, or you're doing similar work, feel free to drop a comment in the comment section down below. And I'm always open to discussing ideas and getting feedback. Um, understand it at the BI edge here, understanding the system is the edge. Thanks for watching today.